I think the China-U.S. relationship is always a challenging part, and it concerns many investors. And I believe when it comes to the bond market, and basically the China's policy reaction to to the U.S. Trade protectionism, and also the U.S. interest rate fluctuation. So that's the main two facets that could potentially affect China's bond market. And for the first part, let's talk about the tariff. So actually, the China and U.S. trade consists only, based on our estimates, consists only like 3 to 4% of China's GDP. So even if this figure continues to decrease, it won't have a substantial impact on China's economy. However, the investors could be overreacted. If like the U.S. is really raising the tariff, and the market participants, they will they will be emotional. They will have different expectations. So that will amplify the negative effect. So the Chinese government is trying to, they're using the positive, proactive fiscal approach right now and try to counteract the negative effect going forward. And we're still seeing like China will have more, because Chinese government still have more tools in its financial toolkits. So we're still seeing that maybe in the future, the China will roll out more fiscal stimulus to support the economy, to stabilize its bond markets. So the second part is the fluctuation of the interest rate. So for this part, I think the Chinese government, if the U.S. continue to lower to execute their interest rate cuts, so that will allow the Chinese government to have more room to execute their monetary policy. So generally speaking, I think it's the stabilization will maintain.